On Monday, one pharmaceutical stock fell 7%. Its rumored target rose 6%. Same story, opposite reactions. The Financial Times reported that AstraZeneca had held early talks to acquire Bristol Myers Squibb in a deal that could value the combined company near $400 billion. If it happens, it will be the largest pharmaceutical merger in history, bigger than anything Pfizer, Merck, or Roche has ever done. Neither company has confirmed it, and most analysts think it probably won't happen at all. But the fact that AstraZeneca even explored it tells you something real about where the drug industry is headed. So let's dig into the actual case for this deal, the pipeline math behind it, and the bigger question it raises. In pharma today, does being massive actually help you win? First, the facts and the caveats. Bloomberg and the Financial Times reported that AstraZeneca explored buying Bristol Myers Squibb, with talks described as preliminary and early stage, the kind of conversation that often goes nowhere. Neither company has confirmed anything publicly, but the market reacted instantly. AstraZeneca's stock dropped as much as 7%, while Bristol Myers jumped 6%, investors pricing in a takeover premium on one side and deal financing risk on the other. There's also a bit of history here. 12 years ago, in 2014, AstraZeneca famously spurned a takeover bid from Pfizer. Now, it's reportedly the one exploring a takeover of a company nearly its own size. Let's look at why. Start with what AstraZeneca actually is today. It's built its identity around solid tumors, drugs like Tagrisso for lung cancer, Enhertu for breast cancer, and Imfinzi across several cancer types, plus a strong cardiovascular, renal, and metabolic business anchored by Farxiga, a respiratory franchise, and a rare disease unit built around its Alexion acquisition. It's a genuinely global company, and that's actually a weak point. Only about 42% of its revenue comes from the United States, the single most profitable market in the industry. AstraZeneca is broad, diversified, and international. Bristol Myers Squibb is a very different shape. Bristol Myers Squibb is narrower, and it leans hard into blood cancers and cell therapy, Opdivo, Reblozyl, and CAR-T leaders Breyanzi and Abecma, plus a genuinely novel new schizophrenia drug called Cobenfy, and a growing cardiovascular franchise. And unlike AstraZeneca, Bristol Myers is heavily U.S.-weighted. About 69% of its revenue comes from American patients and payers. So line the two companies up, and the fit is almost suspiciously clean. AstraZeneca is strong in solid tumors and international markets. Bristol Myers is strong in blood cancers, cell therapy, and the U.S. On paper, that's not overlap. That's a jigsaw puzzle. This is the strategic core of the rumor. AstraZeneca's oncology engine is built for solid tumors, lung, breast, ovarian, and beyond. Bristol Myers is built for blood cancers and cell therapy. Combine them, and you're not just adding two pharma companies together, you're assembling what analysts already describe as the deepest, broadest oncology portfolio in the entire industry, with combined annual sales approaching $100 billion. That breadth matters more than it used to, because the next era of cancer treatment isn't really about single drugs anymore. It's about combinations. And that's where this deal gets genuinely interesting, beyond just adding up two sales forces. Here's the detail most coverage missed. Imfinzi, AstraZeneca's immunotherapy, and Opdivo, Bristol Myers, are direct rivals today. Different companies, different sales forces, competing for the same prescriptions. But modern cancer treatment increasingly means stacking multiple drugs together, not choosing one. As separate companies, combining Imfinzi or Opdivo with each other's other assets means slow, messy co-promotion and licensing deals. Owned by a single company, that friction just disappears. Analysts at Jefferies put it plainly. The strategic logic here may extend beyond simple cost synergies, toward competing on who owns the largest portfolio of assets that can support complex combination regimens. In other words, this might be less about cutting costs and more about owning the entire combination chessboard. There's a second, quieter reason this deal makes sense on paper: geography. The United States is the most profitable pharmaceutical market on Earth. Higher prices, faster reimbursement, and it's where new drug launches make or lose their money. AstraZeneca gets less than half its revenue there. Bristol Myers gets more than 2/3. A merger wouldn't just add product lines together, it would hand AstraZeneca a much deeper American commercial engine, sales reps, payer relationships, and launch infrastructure. Overnight, instead of building it slowly over another decade. Combine the oncology fit with the geographic fit, and the strategic logic starts to look less like a stretch and more like a plan. But none of this explains the timing. For that, you need to look at the calendar. This chart is probably the real reason this rumor exists at all. Bristol Myers is staring down one of the steepest patent cliffs of any major drug maker. Revlimid, once its biggest product at nearly $13 billion a year, has already collapsed after generics arrived in 2022. Eliquis, its blood thinner, faces U.S. generic competition starting around 2028, putting roughly $11.5 billion a year at risk. Opdivo's core U.S. exclusivity ends around the same time, exposing billions more. All told, analysts estimate as much as 64% of Bristol Myers' 2025 revenue is exposed to loss of exclusivity by the end of the decade. That is an enormous hole to fill through internal pipeline alone. AstraZeneca faces its own cliffs. Farxiga and Soliris already lost exclusivity in 2025, and Lynparza is next in line. But the degree is completely different. AstraZeneca backs its cliffs with more than 90 late-stage pipeline programs, each projected to average around $1 billion in peak annual revenue, and it's publicly targeting $80 billion in total revenue by 2030, cliffs and all. Bristol Myers has a real pipeline too. Its newer growth drugs like Camzyos and Cobenfy are growing fast, but it's racing to replace a much bigger hole, starting from a smaller base. Put simply, both companies face the same industry-wide problem. Bristol Myers is running out of time faster. To understand whether this deal fits the moment, you have to see the backdrop. 2026 is already one of the biggest years for biotech deal-making since before the pandemic. Over $100 billion in the first half alone, more than 30 deals worth $1 billion or more, already ahead of all of 2025. But look closer, and almost none of that volume is mega mergers. It's bolt-ons, targeted acquisitions in the $1 to $5 billion range. The kind GSK just did buying RAP Therapeutics for around $2 billion. Truly massive, $10 billion plus mergers are rare for a reason. Historically, they're hard to integrate and hard to make pay off. Which brings us to the real question underneath this whole story. So does being massive actually help you win in pharma today? There's a real case for yes. Bigger companies have more capital to win competitive auctions for hot biotech assets outright, without financing risk. And that matters more now that private equity firms are bidding for the same targets. Scale also means you can run several smaller bolt-on deals at once instead of betting everything on one, and a broader portfolio means no single failed drug sinks the whole company. And a bigger commercial engine can launch a newly acquired drug in more countries, faster than a smaller buyer ever could. That's the pro-scale argument, and it's genuinely strong. But it's not the whole picture. Here's the case against. Historically, giant pharma mergers integrate slowly, cultures clash, and key scientists often leave right when you need them most, and study after study has found that research productivity tends to fall, not rise, in the years after a mega merger. There's also a sharper problem. Size itself invites regulatory scrutiny, and the bigger you get, the more of your own pipeline becomes off-limits to acquire because it would concentrate the market too much. This exact deal is the case study. AstraZeneca and Bristol Myers together would have such a dominant, overlapping oncology portfolio that most analysts think antitrust regulators would block it or get it through forced divestitures before it ever closed. Jeffries called the idea a head-scratcher. Fierce Pharma's editors called it, bluntly, a bad idea. So where does that leave us? The strategic logic for this deal is genuinely sound. Complementary drug classes, a U.S. commercial gap that closes overnight, and a patent cliff that's forcing Bristol Myers' hand. But the very thing that makes the deal powerful, sheer combined scale, in overlapping cancer drugs, is probably also what kills it or forces regulators to carve it up until it's unrecognizable. If talks quietly fade, don't read that as the strategic thesis being wrong. Read it as confirmation that Bristol Myers needs a partner badly, and watch for a wave of smaller bolt-on deals instead, the kind that actually tend to close. So, does being massive help you win in pharma today? The honest answer is, it depends what you're winning at. Scale helps you outbid rivals and survive a bad quarter. It does not automatically help you integrate a rival's culture, keep its best scientists, or get a deal past regulators, especially in a world sizing up mega mergers more skeptically every year. AstraZeneca and Bristol Myers may never actually merge. But the fact that a $400 billion idea got floated at all tells you the patent cliff is reshaping this entire industry's decisions, whether or not this particular deal survives contact with reality. Thanks for watching. This has been a Life Sciences AI commercial deep dive.